All right, ladies and gentlemen, it is time once again for Mises Weekends. Very pleased to be joined by a friend of ours, Professor Steve Hanke. A lot of you will know he teaches at Johns Hopkins, frequent writer for Forbes magazine, but for our purposes today, he is involved with, actually heads up, the Troubled Currencies Project at the Cato Institute, which is very interesting given what's going on in Turkey and Venezuela. So, Professor, great to see you. Thank you.
Jeff, great to be with you.
Well, I'd like to start off with a little bit of background. I know from speaking to you that you knew Hayek, you knew Milton Friedman, you knew Murray Rothbard, you know Ron Paul. Give us a little background on how you came to be involved in economics and Austrian thought.
Well, I was involved really from almost the time I could walk in markets, because I grew up, I'm an Iowa farm boy. And as an Iowa farm boy, you listen with your grandparents, your grandfathers in particular, to two radio reports every day. One is the weather report, and you listen to the weather report because that influences the quantity of grain that you're going to produce. And you also listen to the price reports and the stock reports especially from Chicago and Omaha, because that will determine the prices you're going to receive for the quantities you produce. So supply and demand, you get onto that pretty quickly. And then in addition to that, I became actually fairly sophisticated with derivatives at about age 10, because I was helping one of my grandfathers hedge eggs. He had, in those days, he had a big egg operation, and they would go around and collect the eggs every day on egg routes from farm wives, would be raising the chickens, collecting the eggs, and we'd go around and collect them, and then we'd bring them in, and what they do is candle them. You put them under a light, see if the egg is any good or not. You grade the egg, clean the egg, and then you put them in cold storage. Well, the cold storage, they stay there for a while before you ship them back to New York from Iowa. And in that time interval, there's price risk. And so what we would do, depending on where we thought the markets were going, we would sell eggs forward with an egg contract that was on the Chicago Mercantile Exchange at the time. This is 65 years ago. So at 65, I was trading derivatives and learned how to hedge with my grandfather. And then by the time I was 14, that was 61 years ago, I had my own trading account and was trading especially soybeans. So all of that would be, plus I had a million jobs and everything else. All that would be illegal today, with child labor laws. You couldn't work, and you obviously couldn't open an account and be speculating in soybeans. But at any rate, that's the market thing. So markets were just natural. I understood markets. We would take livestock, especially to Omaha, and you'd watch the auctions, and you even knew how the auctions worked and so forth and so on. Then I entered university at the University of Colorado in 1960, and the first course I took in economics, the first formal course, was taught by Raghel Malak, and it was on European economic history. But he was a great devotee of Schumpeter, so he would trumpet Schumpeter literally every lecture. And so technically, that's the first time I came in contact with an Austrian economist, was in El Malak's course. Then by the time I entered graduate school, started graduate studies, one of my professors was Fred Glahe, who he's a friend of the Mises Institute and has written several books on Hayek and Austrian economics. So Fred was teaching theory at the time as well as econometrics, and I had Fred, and he was one of my dissertation advisors, actually. So that was a little, also some Austrian, and then the other one at the University of Colorado is Ken Boulding, was one of my professors, and of course Boulding was very, he wasn't an Austrian, but he was very familiar and introduced and very friendly to Austrian economics. Then if we jump after I received my PhD in 1969, I was actually doing very applied micro systems analysis, doing things like designing water systems and basically figuring out how big the pipe should be for an optimal system, that sort of thing. It's super micro. And I had an appointment in the late 1970s at the International Institute for Applied Systems Analysis. And that's located at a Schloss outside of Vienna. And Mrs. Hanke and I actually lived in Baden by Wien for about a year. And just being in the environment was the clincher for me. I mean, that was it. And at about that same time, of course, Hayek received his Nobel. And I remember I don't exactly know how this was arranged, but we had the good fortune to have a private dinner at the Maison Blanche restaurant in Washington, which was a great restaurant at the time. This was about, I think, 1980. And so Hayek got in a very deep conversation about psychology and philosophy with Mrs. Hanke. And finally he stopped and he said, you're French, but you seem to have kind of a German accent. He said, do you? And she said, well, I suppose I do, because half of the family is from Vienna. So he asked the maiden name, and Hayek asked if Mrs. Hanke knew so-and-so. And she said, yes, that's my great aunt. And Hayek said, the most beautiful and intelligent woman in Vienna. And one of my great flames. And apparently the flame was extinguished when he came to the United States on a Rockefeller Foundation fellowship. And when he went back, the aunt was married to actually a judge in Vienna, and that was the end of that chapter. But we had a great meal. They finally threw us out at midnight from the Maison Blanche. We took Hayek back to the hotel, accompanied him up to his room to make certain everything was okay. He had a little bottle of schnapps next to his bed. He said he always had a shot of schnapps for medicinal purposes before he went to bed. And he did so, and we said goodbye. And so we stayed in very good contact, obviously, ever since that. And then later than that, the last couple of years of his life, the great Austrian economist Haberler lived in Washington, and Mrs. Hanke and I would always go down at least once a week and have tea with him and make certain he was okay. He was in his 90s. Austrians tend to live, as you know, pretty long. So fortunately for us, they usually go into their 90s.
Well, it's all that hiking and mountain air, I think. But
well, a schnapps is okay too.
Yeah, and the schnapps. Now, lately you've been really all over the financial talking head shows talking about hyperinflation. How did you become involved in studying currencies and in particular studying hyperinflation? And how did this become a niche for you?
Well, this became a niche because in 1985, this is an Austrian connection. I've been a professor here at Johns Hopkins for almost 50 years, and I'm proud to say I was the fastest one to ever be promoted from PhD to full professor. And under the old regime, the old German regime we had at the time, and that is that the only way you could get tenure at Johns Hopkins was to be a full professor, or as they used to say, a full bull. So in any case, 1985, I got a call from Dr. Albert Friedberg, who you know at the Mises Institute. He's been involved with helping the Mises Institute. And Friedberg said he was a very known commodity and currency trader in Toronto, and a very Austrian in his orientation. And he'd read a few things that I'd written in Barron's at the time. And he said, could you come and have lunch in Toronto? And I said, fine. I went up and saw him. And by the end of the lunch, I was a chief economist at Friedberg Commodity Management in Toronto. And we were trading commodities, which was fine. The first big trade we had, by the way, that I was involved in. I did kind of a plain vanilla analysis and modeling of the oil market and concluded that OPEC would collapse and oil would go below $10 a barrel. So we put every kind of short position on we possibly could, including shorting the Saudi rial and the Kuwait dinar. And as you know, OPEC did collapse in 1986. Oil prices actually did go below $10 a barrel. All of our ships came in, and I thought, gee, this is easy. This is great. And our positions actually, ex post facto, we found out were just huge. We had 70% of all the short interest in the gas oil contract in London. So we were really very big players. And that gets into the currency. Mm-hmm. So then we had other big trades, which I don't have to bore everyone with it trade by trade. But in 1995, I was the president of one of our units, Toronto Trust Argentina in Buenos Aires, and that was the best performing fund in the world in 1995. We were up 79.25% on what was in effect a currency trade, because we had one position. This idea of diversifying portfolios is, of course, completely silly. You can diversify and you have a lot of holes in your basket, as they say. But if you know what you're doing, you get one big position and you stay with it. Our position was Argentine bonds denominated in pesos. 1995, the tequila crisis. Everyone said Argentina would collapse, and they had a convertibility system that we thought we understood. The currency system, and so we put everything in that basket, and it turned out to be a good one. So that's the start. Now fast forward to so I've been trading currencies for, well, really since 1985, and still I'm trading currencies actively. But the hyperinflation thing comes into the picture because it is related to currencies, because if a currency collapses, inflation soars. And there have been 58 hyperinflations in world history. And all of those have involved currency meltdowns, complete destruction of the currency, and then the hyperinflation takes off. And you say, well, how does all this happen? I mean, and it happens very simply, as Friedman taught us, of course, that everywhere and every place, inflation is the result of increases in the money supply. Well, that is true, but there's more to the story, and that is, well, why does the money supply grow so fast? And the money supply grows because in these hyperinflating situations, the government spends money, and for one reason or another, their financing sources either don't exist or dry up on them. And what are the financing sources? You can have taxes, and your tax base can dry up on you. For example, when the former Soviet Union collapsed, or what happened in the Soviet system, there weren't taxes. There was no tax administration at all, and so all these new countries where the government was spending money, but they didn't have any tax system. So in the case of Venezuela, the tax system, and so you had a lot of hyperinflations around the time the Soviet Union collapsed, because no tax revenues. The bond market, there was no bond market in those countries. They didn't have bonds, and domestic bonds anyway, and international bond market, they were cut off from that. They weren't established, so they had no source of revenue there. So you go to the central bank, if you're the fiscal authority, and you say, we've got some great bonds to sell you. And the governor of the bank says, yes, I agree. And he basically turns on the printing press, literally, and you're off to the races. And as you do that, as the inflation starts going up, the tax base, if you have one, starts disappearing in real terms on you, because inflation is going up, and you have something called the Tansey effect. Vito Tanzi is the economist behind the Tansey effect. So the Tansey effect works like this. If inflation is going roaring away and going up and
Mm-hmm.
up and into triple digits, and your tax bill comes in December, but it isn't payable until April. Well, by the time the government gets your money, it's not worth very much. So the tax base shrinks, and the bond market's shrinking, and you just keep going back to the central bank for more and more and more, and the thing takes off. In the meantime, of course, people's expectations, people are rational, and they expect the currency to collapse because it's losing purchasing power. So they get rid of the local currency. In the case of Venezuela, the bolivar is a hot potato. And what do? You either buy commodities, but of course, Venezuela is fundamentally a socialist operation, and there are no commodities to buy because everything's under price controls. So right. You can't buy many commodities, not much sugar to find. The shelves are empty. So you go to the black market and you get dollars as fast as you possibly can, and the currency on the black market or the free market really collapses, and you get this kind of vicious cycle going on, and you're really dead in the water, and it just keeps going and going, and it can go to extremes. I noticed and observed very carefully the hyperinflation in Yugoslavia, because in 1990 I actually was the chief advisor for the new Markovic government that was going to throw out socialism and reform the economy. It never happened because Milosevic took over. The socialists, the old communists, took back over. And what happened? Hyperinflation. And at the end, in January of 1994, the hyperinflation had reached 313 million% in 1 month. In 1 month. I mean, this is just unreal. But if you look at the model, of course, the money supply was going up, but the real engine of the thing was this huge fiscal deficit in which the central bank was supplying 95% of the finance for government expenditures was coming from the central bank. The taxes base was completely gone. There was no bond market. And that was a story there. And it's a story with every one of these hyperinflations. If there was a hard budget constraint on government expenditures, it becomes softer and softer, and finally it just completely disappears. And there you are. You're kind of in the soup. So that's the long and the short of it. The real innovation, Jeff, that I came across is using purchasing power parity to be able to translate changes in the exchange rate into changes in the inflation rate. And you can measure it. Once you get into hyperinflation, it's just 1-to-1. It's a perfect, absolutely perfect correlation, because the economy in a hyperinflating situation like Venezuela, it is dollarized already. The unit of account is the US dollar. Everything in Venezuela is calculated in the dollar. So you get a little movement in the Bolivar dollar exchange rate that's translated right away into overall inflation. And so that's the kind of insight that I had. It's an old theory, purchasing power parity, but the way it's usually used is to look at inflation differentials and try to predict what's going to happen to the exchange rate. Now I've reversed it. I look at what happens in the exchange rate to see what the inflation rate is. And in hyperinflation, actually you can do it, and you can measure things very accurately. Now, I should warn the people listening, you get lots of stupid things done by the IMF. Of course, we all know that. But one thing they're doing, they're claiming that they can forecast where hyperinflation is going to be at the end of the year. Well, you can't forecast the course and duration of a hyperinflation. It's totally impossible. So they have no forecasting model. It's absolutely a sham, but you see it in the newspapers all the time, because this is a big international government-sponsored organization, and they have credibility.
Right.
So the reporters are like stenographers. They report whatever the IMF says. They report it, and you will find that now about Venezuela all the time. And actually, I can tell you, today the inflation rate is 65,320%.
Wow.
I measure it every day, and I know exactly what it is, and that, by the way, is a basket of everything. It's just not consumer goods, but all consumer goods, all services, all assets, anything that moves is included in my aggregate basket.
Well, one thing I'd like to mention about Turkey, and we see this all the time, I wouldn't really call Turkey an emerging country with 70 or 80 million people, but nonetheless, we see this time and time again in that the Turkish government borrows in dollars and euro, and it can only produce lira to pay against that borrowing. So there's sort of a whipsaw effect. They owe money in a currency they can't print.
Yes, that's the nub of the problem, and that's fine if your currency was stable. Let's say for that's fine for some place like Bulgaria, where I put a currency board in 1997 to stop, by the way, a hyperinflation. Now that's a good example, Jeff, of a hyperinflation I witnessed because I was President Stoyanov's advisor in 1997, and hyperinflation was running at 242% per month, not per year, per month. And so the question is, what do you do? And I said, you make the lev, which was the currency, a clone of the Deutschmark. Now, how do you do that? How's that trick work? You do a currency board operation. You set up a currency board law, and that means you can issue lev, but the lev have to be backed 100% with Deutschmark reserves, and the lev has to trade at an absolutely fixed exchange rate with the Deutschmark. So a lot of Austrians get this completely mixed up. They think, oh, fixed exchange rate, that's like price controls. That's a disaster, that's a bad thing. No, it isn't at all. The supply curve under that arrangement with the lev is completely elastic in the old days at a fixed exchange rate with the Deutschmark. Since then, of course, it's with the euro. So you have a completely elastic horizontal supply curve, and the demand curve moves. The demand curve is the demand curve for lev. So the quantity of lev in circulation is dependent on the demand for lev at that fixed price. And it's freely convertible, totally free market. And what happened? We put that in July 1, 1997. Hyperinflation was crushed within hours. And of course, when you start out, the interest rate in lev-denominated assets is a lot higher than Deutschmark assets. So the demand for lev does what? It explodes. Everyone wants lev. So they take their marks in and exchange them for lev to arbitrage and go from a low interest rate yielding currency into a high one. And eventually what happens? Of course, the interest rates in Germany and Bulgaria on a risk-adjusted basis come down and are about the same. Now it's back to Jeff's question, which is a critical one. Bulgaria can borrow in euros without any of this kind of risk. They don't, by the way, because they have a very hard budget constraint. They can't go to the central bank and say, turn on the printing press. The only way they could do that is if they took euro reserves in there to exchange for lev, you see. So there's a totally hard budget constraint. The deficit, the fiscal deficit is very small. They don't borrow very much. The debt's very small and so forth. But if they did, they wouldn't have any problems. They wouldn't run this currency risk that you're alluding to, Jeff. Because the lev is a clone of the euro. Well, the lira is not a clone of anything. It's not attached to anything, and it's completely disintegrated in 1994. It completely disintegrated in 2000. It is essentially almost completely disintegrated in 2018. And under that situation, if your revenue and funding sources are in lira, and your liabilities are all in dollars, the mountain of debt is in the financing obligations are huge on you. And so this crush will come into play, and there will be many firms and organizations in Turkey that go to the wall because of the debt and because of the government's mismanagement of the currency. So I've recommended all the time and most recently I've recommended, mainly for political reasons, they should have a gold-backed currency board system. So should Iran, so should Russia. They should all introduce. They should keep their local currencies for nationalistic reasons. They want to do that. So you'd still have a ruble, a lira, and a real, but all those would be backed 100% with gold. They trade at a fixed exchange rate with gold. They'd be freely convertible into gold, and you'd have a gold block of Turkey, Iran, and Russia. I've just written about this. I think it's the only way for them to go to stabilize their currencies. That all those currencies have been half-baked, never attached to anything historically. Oddly enough, in Russia, they actually have had a currency board before, and it was introduced in 1918. And who designed it? John Maynard Keynes, actually. And so Keynes was a Treasury official at the time. No one knew that. Kurt Schuller and I dug this thing up. It isn't even in any of Keynes's works, but we found in the archives he is the guy who did it. And the White Russians at the time wanted a stable ruble. There were about 2,000 rubles circulating at that time in the Civil War, issued by various entities, all private as well as the government. They weren't worth much. They weren't backed by anything. They weren't redeemable into anything. So Keynes said, "We'll set up a ruble currency board in North Russia, and the North Russian currency board ruble will be redeemable into pound sterling and backed 100% with pound sterling reserves." The thing worked beautifully. The war ended, and they still were redeeming in London those rubles. Everyone got paid. The ruble was as good as sterling. And what I'm suggesting for Iran, Turkey, and Russia, they should make their currencies as good as gold, and we should have a gold block again. And in short, they should go on the gold standard.
Why do you think someone like an Erdogan or a Maduro, is it simply hubris and ego that prevents them from doing this? Is it a lack of historical knowledge? Is it something darker?
I think it's a lack of historical knowledge, for one thing. There probably is some hubris, and I think I can't speak about Russia exactly right now, but I know in Iran, and I know Venezuela very well because I was President Caldera's advisor in 1995 and 1996, and the incompetence is just beyond belief. So there's a lot of just pure ignorance. They don't actually know about how they would do one of these things, and when you look at someplace like Bulgaria, I mean, I can tell you, I fixed the thing in hours. We're talking about hours. We're not talking about even weeks, because people are rational, and people change their expectations almost instantly if you come up with a credible system that they can understand, and you can understand something like a currency board system.
But when we look at Turkey, we see a lot of foreign bank debt, just as we did in Greece a few years ago, just as we did in Iceland. Should those foreign banks be prepared to take a haircut? Isn't that the proper resolution to their loaning money to what appears to be a profligate government in Turkey?
Oh, that's what's going to happen. I mean, whenever you get into these unsustainable debt burden situations, Jeff, and many people don't realize this, or maybe they realize it but just don't say it. you're bound to be talking about haircuts. I mean, there are going to be losses involved, and if there aren't losses involved, you'll be struggling under a mountain of old debt that keep you buried forever, and you'll never recover. That's why, by the way, in Greece, they really haven't taken sufficient haircuts. Point number one. Point number two, the property rights system and judicial system is a complete disaster in Greece. And until they learn the magic of private property rights, they are never going to recover. Most people don't realize that Greece is a Balkan country. It's in Europe, but it's in the Balkans. And this is Balkan history. So you really have to know your history. I mean, any Austrian would know this because, of course, the Balkans were part of the empire for a while, or at least part of them. We're talking about Austria and Turkey. The Balkans were part of either the Austrian Empire or the Ottoman Empire. So that history is relevant. And if you read Mises, by the way, he has a lot of interesting things to say about the Balkans. In terms of cultural history and things like that, as well as economics, of course.
Speaking of debt, let's talk about the dollar a little bit. I know you really look at dollar euro, and I know you really look at dollar gold. What worries you about the dollar? What keeps you up at night?
Well, not the same things. I don't think that a lot of my Austrian friends are kind of the apocalypse coming down the road, or the chicken
apocalypse. Yes,
chicken little types. But if you look at I'm not that type of Austrian. When it comes to the U.S. dollar, when it comes to a lot of these half-baked emerging market country currencies, yes, it's fairly clear. But the U.S. dollar, I'm not quite there. And many Austrians, for example, were fanning the story that we would have hyperinflation in the United States as the Fed exploded its balance sheet after the Great Recession started in 2009. I knew this was just utter nonsense, and they didn't understand what they were talking about, because what happened after the crisis, without going into a lot of detail, you had the Dodd-Frank and regulation of banks. And you have to look for economic activity is driven by the quantity of broad money in the economy that's circulating. Money dominates, and broad money is what you want to measure. So the best measure is, I think, the Divizia M4 measure that's put out by the Center for Financial Stability in New York. Professor Barnett is the guru on this and does all the calculations and so forth. So Divizia M4, you want to keep looking at that. And the big contributors to Divizia M4, the elephant in the room, it's commercial banks. Private banks create most of the money in the United States. The Fed is peanuts. And at the time the crisis started, the Fed was producing about 10% of Divizia M4. So they weren't producing very much. And then you had Dodd-Frank and all the Basel III capital requirements being increased. And that really put a squeeze on private banks and private credit. And the private credit and private money contribution actually started declining. It was going down. So if the Fed hadn't have come in with QE, with quantitative easing, we would have had another Great Depression in the United States. So the first thing that happened that was very pro-cyclical, just what you shouldn't have done. They laid all kinds of bank regulations and capital requirements on private banks and commercial banks. So 90% of our money supply, the contribution to our money supply, was under massive pressure with all these bank regulations and so forth. So the Fed, in fact, did the right thing. They came in with quantitative easing. And if they hadn't come in, we would have been absolutely buried in a huge Great Depression. Now, many Austrians interpreted they looked only at the Fed, only at the Fed. The Fed are the bad guys, of course. The Fed are the bad guys. They are the bad guys. But in this case, they looked at the Fed balance sheet and they said we are going to have hyperinflation, and we didn't have. We had deflation, deflationary environment. We're still in a deflationary environment in the United States. Prices aren't going up. We've never had a hyperinflation. The reason why bank money, by the way, in 1930, the best book Keynes ever wrote was a treatise, at least according to Milton Friedman and according to me and many others. And in the treatise, Keynes separated bank money and state money. And state money is produced by central banks, and bank money is produced by commercial banks. And state money is always tiny, and bank money is always huge. Bank money was 90% of the money supply in 2009, and now bank money accounts for 80%, meaning that the state money has grown as a proportion from 10% to about 20% now due to QE. But at any rate, QE basically saved us. It creates all kinds of distortions and all kinds of other problems are associated with it. But that's more or less the story up to today.
Right, but I mean, just on a tangent here, we look at QE, we look at the Fed's balance sheet, and it goes, it takes almost 100 years to get to 800 billion. Then it goes from 800 billion to 4 trillion in less than a decade. And I think people look at that and say, well, what does that all do? It's just sitting there parked as bank reserves, and now it's slowly being bled off through tapering. But what does it mean? Where does it go? What is its effect?
Let's get to today then. So I had to take many of the doomsters and my Austrian friends to the woodshed, which I just did. But let's now go to today. You said we started, Jeff, by allowing me to go off on this tangent, which I appreciate that. You're keeping me on a long leash today. You said, well, what worries you about the dollar today? And here's what worries me. And here's the problem you create. It's a cascade of government-created problems. The first thing that kicked it off, of course, was we had a Great Recession. That was actually caused by the Fed, which we don't have to go back and revisit that. That was caused by a mistake at the Fed. Okay, then we have the Great Recession start. Then bank regulations. That's something caused by the government. That causes a problem. It's very pro-cyclical. And any principles of economics student knows you want to be counter-cyclical if you do anything. You don't want to be pro-cyclical. So then the Fed comes in and they try to mitigate the damage that the bank regulations are doing, and they put on QE. And then now today, as you said, they're unwinding this massive balance sheet. And this is a tricky situation. And we're, as a result, we have very tight monetary policy right now. And we know it's tight because Divisia M4 is only growing at about 4.7% per year, which it isn't super slow. It's modest, though. That's nominal growth. So let's say the economy is growing at 4%. If the economy is growing at 4%, you subtract the 4 from the 4.7, and you've got inflation of less than 1%. You have very low inflation. So that's one signal. That's looking at quantities. That's a Milton Friedman kind of, let's look at our Qs, the quantities of money, 4.7% growth. If you look at Bob Mandel and the supply siders, which I tend to pay a lot of attention to, you look at prices. And you look first at the most important price in the world is the dollar-euro rate. And my comfort zone for that is about 120 to 140. And now it's about 116. The dollar is very strong. It's outside the zone, dollar strength. Then you look at another very important international price is gold. And my comfort zone is about $1,200 to $1,400 an ounce. And it's trading now. It's been a little below 1,200. It's just popped $20 this morning, and it's over $1,200 an ounce right now. So that also suggests tightness. everything is very tight. And then you throw in your thing with what's happening in emerging market countries. You've had a lot of these currencies. All the capital is coming out of the emerging market countries now, because when the dollar gets very strong, the emerging market currencies tend to get very weak, and capital flows come out of those emerging market countries. So we have a very destabilized kind of situation. It looks kind of calm on the surface, and we got a big bull market in the U.S. stock market, and et cetera. But there are things going on. We've had the Argentine peso lose 38% of its value this year. Turkish lira lost 38% of its value. Iranian rial, of course, is a junk piece of currency anyway. Chile is even lost a lot of value. So all these places where you're losing value, you've got this exposure that you've alluded to, and that is a mountain of debt. Debt denominated in dollars, but you have to generate first the Chilean pesos and then exchange those for dollars at a bad exchange rate to pay off the debt that you've accumulated in dollars. So I'm a little bit nervous about the markets right now.
Are you nervous about interest rates? Historically, Fed funds rate has been more in the 5 to 10% range. Do you think we'll ever see that? And again, and what would it mean?
Well, it would mean that the emerging market countries are not the place to be. That's one thing, because when we had QE on and interest rates were essentially zero in the United States, everyone was chasing yield. And you see, Roger Garrison's work fits into all of this. What happens when you have QE? Of course, it mitigates having a Great Depression, but it creates all kinds of distortions. And one is the interest rate is almost zero. So everyone wants to chase yield. You're trying to find yield, and you're leveraging. You're doing massive leverage. And the combination of those things, you get a lot of overinvestment. So you look at Garrison's books and you can figure this out. His stuff's, I think, the clearest thing on these issues. So you start overinvesting. You overinvest in long-term capital kind of projects, and you go into risky markets. You go into emerging markets. You put it risk on. It's risk on, they call it. And now with the dollar getting stronger and the interest rates going up in the U.S., you get everyone unwinding the carry trade. Everyone's starting to deleverage, and risk off is what you're seeing. And so risk off, you get into less risky assets. So all these distortions, and this is, of course, the beauty of Austrian economics. The emphasis is on these distortions. I just wish younger Austrians, as well as older ones for that matter, would pay actually more attention to actual real markets, because it's all in the markets. And if you're trading the markets, it's just so natural Austrian that you don't even think about it. I mean, you don't go to a big Austrian textbook or treatise. You just know it. Yeah. and if you do go to the treatise, you will find it.
Running out of time. Got to ask you a final question that relates to all of this, and certainly relates to the dollar. Give us your thoughts about U.S. debt and entitlements in the future. What does that mean? Certainly, the dollar is very strong right now, looking strong as other currencies wobble. But should we worry about the debt? Should we worry about deficits? Should we worry about Trump? And most of all, should we worry about entitlement promises for the future?
Well, I don't stay up too late at night worrying about debt. I mean, it's coming. If you're trading, that's another thing. I mean, you do have a time horizon, and it's not 30 years. Now, I realize expectations come into play and can make 30 years come back to haunt you today if you're trading in the market and something is happening to you with unfunded liabilities coming up. So overall debt, not too much worried. Entitlements, totally worried. All these things are bankrupt and will never be paid. So just forget entitlements. I mean, they're all broke. everyone knows they're insolvent. So they'll play all kinds of games, band-aids here, band-aids there, and so forth. But the reality is none of it's ever going to be paid. And the only way to solve the biggest entitlement, or one of them, now there are others that have gotten huge, Social Security. Really, you have to have a private Social Security system. If you look, for example, it is mandated, but the Social Security system in Chile, of course, is the model. I mean, that is a real private Social Security system that is done extremely well, designed by our friend Jose Pinera, and does beautifully. There's another one that is interesting, and that is after Singapore became independent in 1965, Lee Kuan Yew, they put in it is a private, in quotes, system. Mm-hmm. It's a self-finance system. You're mandated to put so much money in, but you own the money that's in there and the returns. And actually, that fund and the wealth fund that they have in Singapore, it's one of the biggest sources of revenue for the government. It finances government expenditures. So we have to get away from these pay as you go kind of systems that everyone knows they're phony, and they're bound to break the bank. And this is one reason, by the way, that a lot of the left-wing politicians want open borders with massive uncontrolled immigration, is to finance these systems. As the demographics naturally are tilting towards older and older, more aged populations, it puts tremendous strain on these pay-as-you-go systems, because they don't have enough young serfs working the system to pay for them. I mean, it is a form of serfdom, actually, but they want to import serfs, and they don't want any control over the borders, and they just want warm bodies to generate as many contributions to these unfunded liability programs that the government has. So that gets into a whole nother set of discussions that we might have. But you did mention the word Trump in that laundry list of things. So what are you worried about? And Trump, yeah. I'm very worried about Trump, because he's got two things that he's doing. He's blasting off sanctions as if they're misguided or unguided missiles every day. Now, this is a potential vulnerability spot for the U.S. dollar, because the U.S. dollar, all commodities are priced in dollars internationally. All payment systems are run in dollars or dollar denominated. But what happens if people lose confidence in using the dollar and the dollar payment systems because there are financial sanctions being imposed on God only knows who tomorrow? So sanctions are equivalent to tariffs. They're interferences with voluntary exchange, and Trump is very keen on both sanctions and tariffs and a whole array of protectionist kind of trade policies. This is we could do another whole show on this, but this is very, very worrying, actually. This is an immediate worry. The unfunded liabilities are an intermediate worry. The overall aggregate debt is kind of way off in the future, not worrying me very much. I mean, I don't like it, but because it's a form of a lying price. You see, if you don't charge somebody now for what you're giving them or what they're consuming or what they're demanding for you, and you're requiring yourself to go into debt to be able to finance whatever you're giving them, you're giving them a lying price. That's why I like balanced budgets. If the government wants to spend, fine. Force them to balance a budget and force them to go to the people and say, oh, if you want this, we're going to increase your taxes to pay for it. And we don't do that now. We just go into debt. So everything supplied by the government is kind of a lying price. We think we're getting something at a fairly low price, but the government's not telling. Oh, we've had to have a huge accumulation of debt to finance what we're giving you today. So I'm very much against lying prices, and I suppose I can revise somewhat what I just told you, and that is that, yeah, I am worried about the debt, but it isn't like it's going to be apocalypse tomorrow kind of thing, which some people get so worked up about it. They give a huge percentage and say, I'm going to wake up tomorrow and, the whole place is going to explode on me. It's not going to happen tomorrow, but it's a sickness in the system, these lying prices. Governments, if they want to do things, they should charge full price, full cost up front, and let people decide then. And my view is people will decide to put a thumbs down on a lot of government activity if that was the case.
Well, amen to that. Ladies and gentlemen, if you want to know more about Professor Steve Hanke, you can find him on Twitter. He's got 80,000 Twitter followers and a very active Twitter account. He's on a lot of the Talking Head shows. You can follow him at Steve_Hanke, Hanke. Professor, thanks so much for your time. Great talking to you.
Yeah, great to talk to you, Jeff.
Subscribe to Mises Weekends via iTunes U, Stitcher, and SoundCloud, or listen on Mises.org and YouTube.